required to fill out a certificate of incorporation and a state charter to do business in that state. Most of the companies in the tri-state area, you should know, incorporate themselves in the state of Delaware because the tax laws in the state of Delaware are the most conducive and inducive to new startup companies, unlike any other state. And so I want to share with you a company that was incorporated in the state of Delaware in the year of 2000. And when a company fills out a state charter, they are assigned, which means given, a certain number of shares of common stock that they may be authorized to issue. Now, to issue shares is to sell shares to the open market, where the proceeds of shares sold will be infused into the company in the form of capital for multiple financial purposes: cash flow, capital spending, liquidity needs. Are you with me so far? Yes. Firm up capitalization. And so I want to share with you this company that incorporated itself in the state of Delaware in the year of 2000. When they filled out their state charter and they were incorporated, they were assigned, which means given, a certain number of shares of common stock that they were authorized to issue. This is known as authorized stock. Authorized common stock is the maximum number of shares of common stock that a company can sell to the open market to raise capital at incorporation. And I'm showing you a company that was allocated the ability to issue 5 million shares of common stock at $1 a share. If they issued all these shares they were authorized to issue, they would raise $5 million. Are you with me so far? Yeah. The company comes down to Wall Street and says to Morgan Stanley, Da1, look, we want to get started here. We want you to consider bringing us public, Morgan Stanley, Da1, and raise us $2.5 million. $2.5 million is represented by the sale or the issuance of 2.5 million shares of $1 a share. This is now called issued stock. Issued stock are the shares that are actually sold to the open market. Are you with me?
Yes.
That's represented by a $2.5 million IPO, initial public offering, for stock that's sold at $1 a share to raise $2.5 million. Of their maximum 5 million shares that they were authorized out of incorporation. Are you with me so far?
Yes.
What should happen if down the road after the underwriting and after the offering, the company might want to buy back some stock from shareholders? This reacquired stock is called treasury stock because that stock that they might buy back from shareholders in the open market is then placed into the treasury of the company to be sold down the road for future financing needs. Are you with me so far?
Yes.
So I show you treasury stock, which is reacquired stock. Company buys back 1 million shares of stock from the general public. Are you with me so far?
Yes.
And then that leaves what's called outstanding stock, or the outstanding shares. Now, we have a name for outstanding shares. It's called the float, because these are the shares that are outstandingly held in the public's hands. Are you with me so far?
Yes.
And that has to be the difference between what was originally issued, which was 2.5 million shares, minus what was bought back from the open market from what was issued, which was 1 million shares of treasury stock, meaning that the float, shares that are held in public's hands, is 1.5 million shares outstanding. Are you with me so far?
Yes.
What are outstanding shares? Shares that are floating out there in the open market. The difference between what was originally issued minus what was bought back from what was issued from the open market by the company. Are you with me so far?
Yes.
What you are looking at are classifications of common stock. There is only authorized common stock, issued common stock shares, treasury common stock shares, and outstanding common stock shares. Now, based upon my transaction, are you with me so far?
Yes.
With 1.5 million shares in the float, outstanding shares, how many shares now lie in authorized stock for this company?
250,000?
Incorrect. Incorrect. 3.5 million shares. Here's what you missed. Look at what happened. The maximum number of shares that this company can issue to the open market was 5 million shares at $1 a share to raise $5 million. They didn't need 5 million. They felt to get started they needed a couple of $1 million. Are you with me so far?
Yes.
Specifically $2.5 million. So they issued half of what was authorized in their company. Are you with me so far?
Yes.
After the IPO, after the sale of 2.5 million shares at $1 a share, that left 2.5 million shares in authorized stock. Am I right?
Yes.
Then they bought back 1 million shares from what was issued from the shareholders in the open market. This 1 million shares of treasury stock, known as reacquired stock, is put back into the authorized shares to be issued down the road to raise more capital, leaving 3.5 million shares authorized stock with the float of 1.5 million. You're looking at classifications of common stock for every company. Are you with me so far?
Yes.
When a company wants to raise money and go public for the very first time, you know, Wall Street performs what's called an investment banking due diligence meeting over the company, which is really more of a corporate finance function. And when that company comes in to see Morgan Stanley Dean Witter, they don't meet with you, the financial advisors and salesmen. They meet with the investment banking team of the brokerage firm. They perform a function of the spreadsheeting of financial statements, taking a look at the company's sales and earnings, placing a valuation on the company, taking a look at their sector competition, their growth rate. Are you with me so far? Yes. And that investment banking and due diligence corporate finance function could take several months of investment banking with that company just to answer a key question. Is this a company that we here at Morgan Stanley Dean Witter want to raise $5, $10, $15, or $20 million for and bring them public? Are you with me so far?
Yes.
And so we talk about the beginning process of where a company starts when they come in looking for financing needs. Are you with me so far?
Yes.
And if Morgan Stanley Dean Witter decides that the financial structure of the company is strong enough to justify an underwriting of a new issue, are you with me so far?
Yes.
And I say that because we look for a certain level of sales and earnings and profitability before we'll underwrite and bring a company public to be publicly traded. Are you with me so far?
Yes.
Not all companies can meet that financial requirement. And so therefore you'll see later on today that we might have alternative methods of financing to raise capital for a company through stock and bond financing that might not be an underwriting of a new issue. But back to the underwriting of a new issue and an IPO, the company then will be taken to the next level by Merrill Lynch or Morgan Stanley Dean Witter, and we might say to the company, look, we're really excited about your company. We have every intention on raising you $20 million. You have a strong balance sheet, strong growth, strong prospects, strong patents and technologies with the potential for significant growth based upon a $20 million level of financing, so we're going to bring you public. And the SEC steps in and says to the company, who is the issuer here, they would like to issue their stock to the open market. If you'd like to go public, then under the Securities Act of 1933, which is a federal act that regulates the IPO process for all issuers, for an equity IPO, the SEC says to all companies, you're going to have to prepare a registration statement and send that registration statement over to the SEC and allow us here at the SEC to check into your background, check that registration statement to determine if we'll allow you to continue the steps of engaging in the process of going public. Are you with me so far?
Yes.
Now, the registration statement is the beginning point after investment banking is accomplished and completed in the underwriting process. Under the Act of 33, it's the starting point of where all companies start when Wall Street has every intention on bringing that company public. Are you with me so far?
Yes.
Remember, the registration statement is the most detailed information about the issuer, and it's submitted over by the issuer to the SEC under the Act of 33. Now, how long does it take the SEC to review the information that's contained in that registration statement to determine the accuracy and adequacy of information, all to protect clients from buying a fraudulent stock? Are you with me so far?
Yes.
The answer is 20 business days. This period of time, called the 20 business day period of time, in this underwriting process of an equity IPO is called the quiet period in the market, because no sale of that stock may be communicated to any client when a company is simply in registration with the SEC. During this 20-day business period of time, the SEC is reviewing the information contained in that registration statement to determine if this is a valid company. Now, the SEC's role is more of like a lawyer role. They are not here to determine that people should or should not buy into the stock offering, the investment merit of the offering, just that the information that's contained in that registration statement is accurate. Are you with me so far?
Yes.
So that if anybody does buy that stock IPO, buys an investment in this company, they're buying a company whose information is adequate and accurate. Are you with me so far?
Yes.
That's why the SEC is neither going to approve nor are they going to disapprove the investment merit of this offering, but rather that 20 business day period of time is designed to determine the accuracy and adequacy of information that's contained in that registration statement. That neither approval nor disapproval by the SEC regarding the investment merit of this offering is called SIM, the SEC No Approval Clause. They are not here to approve nor disapprove whether people should buy this stock underwriting. Not here on the investment merit. That's not their role. Their role is to determine that the information that's contained in that registration statement is accurate to protect all shareholders that when they do buy this stock from buying a fraudulent issuer. It's called the SEC No Approval Clause. And it's on the front page of every prospectus. And I'm going to read it to you right now. Now, if you just listen to me very carefully, stocks are sold by means of the vehicle, the prospectus. Always. Look at me. You're looking at prospectuses right here, and I have many here And we're going to take a look and break them down because it's something we need to be responsible for. Whether we're dealing with equities packaged in the form of mutual funds or equities packaged in the form of variable annuities or just a pure stock recommendation. Are you with me so far?
Yes.
All stocks are sold by means of the vehicle, this document called a prospectus. This is what you send out to clients, both in preliminary and final form. And we'll talk about preliminary and final form in a moment. I'm just showing you a final prospectus. I want to read this statement to you that I just discussed with you called the SEC No Approval Clause. Listen to this very carefully. These securities, just listen to me very carefully, have not been approved nor disapproved by the Securities and Exchange Commission or any other state agency. That is the SEC No Approval Clause. They're not here to determine whether people should or should not buy into the stock offering, just to determine that the information contained in the registration statement is adequate and accurate to protect clients from buying a fraudulent issuer. Are you with me so far? How long does it take the SEC to review the information and the accuracy of the information contained in that registration statement? 20 business days. Call the quiet period in the market because you may not sell that stock or speak to clients during this period of time. Are you with me so far?
Yes.
During this 20 business day period of time, the quiet period, where the SEC is reviewing the information that's contained in that registration statement to determine its accuracy, the issuer has to and is required to blue sky this offering. Please listen to me. To blue sky the security offering is to, the words blue sky, to register this offering in states where Morgan Stanley Dean Witter, the underwriter, the broker-dealer that's bringing the issuer public, along with the brokers that work for Morgan Stanley Dean Witter, have every intention on contacting clients in those states to raise capital. Are you with me so far?
Yes.
To blue sky is to register this offering in states where the securities will be sold. Are you with me so far?
Yes.
Also, during this 20 business day period of time called the quiet period, while the issuer is blue skying this offering, the issuer also is required to prepare what are called preliminary prospectuses. Now look at me. We have a name for this document. This is not a final prospectus. This document has a red border. Another name for the preliminary prospectus is called the red herring. Are you with me so far?
Yes.
This is prepared during this period of time of the quiet period when the issuer has blue skied this offering. Are you with me so far?
Yes.
And the SEC is reviewing the information contained in the registration statement. These three areas are occurring at the same time, and I'll sum up this underwriting process in a minute. Now, this document, prepared during this particular period of time when the offering is being blue skied and the registration statement is under SEC review under the Act of 33, is a preliminary prospectus. And this is sent out to clients to seek Series 7 indications of interest of a client who might want to buy into the IPO when it gets approved for sale. Are you with me so far? I show you the red herring to a company. Here's the issuer, look at me, called Healthy Fast Foods. This was a very popular underwriting. It's already been performed in the market. And this was a raise of $15 million for this company by the underwriter who's at the bottom of the red herring and final prospectus called Paulson Investments. Are you with this so far?
Yes.
Brokerage firm. What was popular about this underwriting and its performance and its public interest was this was the very first company that decided to manufacture, if you will, and produce fast foods of a healthy genre. I mean, you're talking about bacon cheeseburgers with levels of calorie content that is similar to tofu. Are you with me so far? And so people said we have an opportunity to eat the fast food that we want, but also get health at the same time. So the company was an innovator in this area, and the performance of the underwriting was very successful. I bring another red herring to your attention. You might know about this company. I kind of save these things because it's important for you to look at, especially in their performance. This was a company on the technological side called GuruNet.com. I don't know if you know the company. You might have heard the company if you're IT-oriented. Performed pretty well in the market in the raising of about $11 million. And so during this particular period of time, you are going to send out the red herring to a client. Mr. Johnson, I'm sending you out the red herring to GuruNet.com and Healthy Fast Foods. I want to get an idea. I'd like you to take a look at the red herring, take a look at the information contained in the preliminary prospectus. If this is a company you think you might want to get involved with once the SEC decides to bring them forward and continue the process when we get ready to go public. And the client says, yeah, I heard about Healthy Fast Foods. I know all about the company. Some of my colleagues are investing in something that just like that, and I would love to buy. Can you put me down for 5,000 shares of that stock? I'm sorry, Mr. Johnson, I can't. You see, this stock has not been approved for sale at this particular point in time. I don't have an allocation. But I will keep you posted as to what the SEC says about the pending performance of the underwriting. Right now, all I can do is send you out the red herring to get an idea as to whether you might be interested in getting involved in a company in this sector. Gee, it sounds great. Okay, so you don't have an allocation, so you can't put aside a certain number of shares for me. Can you tell me where the stock is going to open up at what price? I'm sorry, I can give you a range. The preliminary prospectus, the red herring, has a range anywhere between $14 to $17 a share. It is only the final prospectus that has a final price. So you'll be so far. Yes. He says, okay, well, keep me posted. But I am very interested in that particular sector and buying a piece of the IPO. After this particular period of time, the SEC is going to assign, if they allow this process to continue, are you with me so far? Yes. The most important date for any underwriting. And that date, Series 7, is called the effective date. Now, the effective date is the date that the offering goes effective. And what does that mean? That's the date the security goes public. It's called the effective date. That's the date it opens up in the market at the IPO level. And at that point, once the effective date is established, then what you will do is then at that point, send out the final prospectus, because now you're going public, you have the date, October 28th of 2009. Mr. Johnson, that's the effective date. And at that point, that's when you, knowing the effective date now, send out the final prospectus to a client who might want to buy into the IPO within Series 7, 1 business day of a client's request. You send out the final prospectus to any client who might want to buy into the IPO within 1 business day of a client's request. And that, of course, is for any stock that's going to be listed on NASDAQ or any major exchange. 25 days, Series 7, 25 days from the effective date. 25 days from the date that this stock goes public, you are required to send out the final prospectus to any client who might want to buy into the IPO within 1 business day of a client's request. And so, you just saw right now, at that moment, the equity IPO process and timeline. And what I think that we need right now is a little summation. And so, a few pages after that, look at me. You have a flow chart. Keep going, keep turning. I see where you're at. On the equity IPO process, and I think that we should sum that up right now. Keep turning if you'll allow me the opportunity. I just want to make sure that we're all there. Are we all there? Yeah, 9:13. Let's go to it right now. Are we there? Say yes. Yes. Thank you very much. You're very kind today. From column left all the way to the right, regarding the summation of the Securities Act of 1933 and the regulations set forth by the SEC regarding an equity IPO. Are you with me so far? Yes. Yes. First, what happens? The issuer has to prepare a registration statement and send that over to the SEC and file that registration statement with the SEC with a filing date. Are you with me? Yes. At that point, you may not speak to clients. Column middle is the key to the underwriting process, of course, and that's when the SEC takes the 20 business days, called the quiet period in the market, where the SEC is reviewing the information contained in the registration statement to determine its accuracy and adequacy. They're issuing red herrings to clients, blue skying the offering. And oh yeah, we also, during this particular period of time, column middle, are required under the Securities Act of 1933 to hold what is known as a due diligence meeting, which is a formal meeting at a formal and elaborate place on Wall Street, financial capital, about the impending $25 million capital raise. These parties are pretty wild. They're called due diligence, due dillies. Are you with me so far? Yes. We wear our Xenia suits, our Donna Karan suits, and we're going out there with our best ties, our Brioni ties, because we're going to make a tremendous amount of money booking the underwriting, and they have a tremendous amount of public confidence. Are you with me so far? Yes. We're having booze, we're having food, we're having entertainment, and we're, of course, holding a formal due diligence meeting with a formal presentation by the issuer about their pending $20 million use of proceeds, and all of the financial advisors and brokers are there at these due diligence meetings, and they're pretty exciting and they're required by law, so we live for that day. Are you with me so far? Yes. Going to do dilly tonight. I think you understand what I mean. Then, of course, at that point, the SEC will assign the effective date which is the date that the company goes public. Are you with me so far?
Yes.
And column wide right, that's when you send out, once the effective date is established under the Securities Act of 1933, that's when you send out the final prospectus to any client who might want to buy into the IPO and confirm sales within 25 days from the effective date, within 1 business day of a client's request, if it's going to be a stock listed on a major exchange or NASDAQ, and then that stock is then public. Are you with me so far?
Yes.
As soon as the stock opens up on the effective date out there in the marketplace, it automatically then is trading in the secondary market, which we'll move into in a little while today, known as the aftermarket. That's the IPO process, and I got to tell you how much it costs for a company to go public. Are you with me?
Yes. Yes.
Company comes down to Wall Street, says, please raise me 20 million, 15 million. Traditional banks are not going to be able to lend that kind of money, and we raise that kind of money, billions of dollars a week down here, through equity and bond financing, through equity and bond sales. Are you with me so far?
Yes.
Well, the $250,000 is a normal and average deposit for a company to give Wall Street, just to have Morgan Stanley Dean Witter put their 2 investment bankers on that company for 2 months to perform investment banking or corporate finance due diligence. Are you with me so far? Yes. What happens if after the 2 months, with that $250,000 deposit the company gives to Morgan Stanley Dean Witter for investment banking fees, Morgan Stanley Dean Witter does not determine that this is a company should be gone public? Are you with me so far? Yes. Morgan Stanley Dean Witter keeps the $250,000. Are you with me so far? Yes. What happens if we do decide to bring them public? Well, after the $250,000, there are registration fees, and there's other fees that the company pays Wall Street in stock in the company and warrants that are favorable. Are you with me so far? Yes. As additional compensation. I mean, it's very expensive to go public. Look, there's nothing with greater aesthetic value than an underwriting of a new issue, and everybody's seeing your company go public and becoming publicly traded. But for smaller companies who might not be able to afford the staggering investment banking and due diligence fees, might we have alternative methods of financing that are eligible for these companies who might not be able to afford the staggering expense of going public? The answer is absolutely. Some of the alternative methods, I'm leaving the IPO process behind now. We'll come back to in a minute. Are you going to so far?
Yes.
Reg D, private placement sale of stock. An intrastate method of financing called Rule 147, or a Reg A type offering. What you are looking at, Reg D, 147, and Reg A offering, are 3 alternative methods of financing. Alternative methods of financing that are eligible to issuers that might be more cost effective based upon their economies of scale. Are you with me so far?
Yes.
To raise capital for them through equity and or bond financing when the underwriting process, 1, is unjustified because maybe the financial picture is not strong enough to be able to warrant an underwriting of a new issue, or 2, the expense. Are you with me so far?
Yes.
Might not be able to afford the staggering costs of going public. And so we talk about the first alternative method of financing, and that's called a Regulation D private placement private sale. So company comes down to Wall Street and says, Morgan Stanley Dean Witter, will you raise us 15, 20 million? And in performing investment banking and due diligence, if Morgan Stanley Dean Witter decides to raise that capital but says, look, you're not strong enough financially with respect to your balance sheet to warrant, justify for the IPO. But I'll tell you what we do. We really like your company. I'll tell you what we will do. We'll raise you the $15 million or the $7 million or $5 million privately. Are you with me so far? We'll sell stock to investors privately, not a public sale. The private placement and the private sale to investors is what is known as a Regulation D private placement sale. This is the first of 3 methods of financing that are eligible to issuers. Now, I want you to look very carefully at what I'm about to show you. We said that the prospectus, both in preliminary and final form, are the documents that we send out to clients associated with stock sales for publicly traded companies. Are you with me so far?
Yes.
This is the vehicle that clients go through to determine the risks associated with the investments. Are you with me so far?
Yes.
This is for a stock sale that is a publicly traded company. Here we're talking about a private sale. Are you with me so far?
Yes.
That means if I'm leaving the IPO process behind, I'm also going to leave the document, the prospectus, behind, because we're not talking about a publicly traded company. Clients still are going to need some type of document prepared by the issuer and sent out to clients that allows them the opportunity to take a look at the risks associated with their investment before they decide to buy. Are you with me so far?
Yes.
Now, if you looked quick at this, you might say that, and you might speculate that this was a final prospectus. Why final and not preliminary? Because it doesn't have a border. Are you with me so far?
Yes.
But I want you to take a look at the size of this document. Are you with me so far?
Yes.
That's 2.5 times the size of a prospectus. This is not a prospectus. This is an offering memorandum. This confidential private placement offering memorandum is the document that substitutes what the purpose of the prospectus served for an underwriting of a new issue when a company has Merrill Lynch sell stock to clients privately. Are you with me so far?
Yes. Yes.
In this private placement memorandum, are you with me so far?
Yes.
Look here. There's a section in it I'm showing you right now called a subscription agreement. This, the client reads, is where the client signs, are you with me so far,
yes,
when he wants to subscribe, buy into this private placement sale. Are you with me so far?
Yes.
Now, usually companies that are financed with private placement sale, that money is usually used as a stepping stone by the company as bridge loan financing that ultimately will lead to the underwriting of a new issue a year later. Are you with me so far?
Yes.
This is when the company needs that money the most. Usually the stock is $1.15, $1.30 a share, $1.50 a share, $2.15 a share. Stock is not very expensive. The company is not as strong as it should be to underwrite. Perform the underwriting of a new issue by Merrill Lynch. Are you with me so far? Morgan Stanley Dean Witter. And this is when the company needs that money the most. And usually, when the clients buy into and subscribe into a private placement sale, they are agreeing to lock up their money, Series 7, for up to a 6-month period of time. Used to be 1 year. So now I'm giving you another name for private placement stock. It is also known as Series 7, look at me, restricted stock, because that stock is not freely traded in the open market. You must agree, when you buy private placement stock, or you're buying into a private placement sale, to hold that stock, Mr. Johnson and Mary Smith, for at least a 6-month period of time. And you agree to that when you sign the private placement subscription agreement and the offering memorandum. Are you with me so far? You are automatically agreeing to lock up your money for a certain level of illiquidity for a 6-month period of time under what is called SEC Rule 144, which is a rule by the SEC that regulates the buying and selling and trading of restricted stock or private placement stock. It is not liquid stock. You got to hold it up for 6 months. Now, after the 6-month period of time, look at me. Look at me. Built into the terms of the private placement offering memorandum, the client can then choose one of 2 investment decisions. He can sell that stock back to the issuer and receive his fixed 6% or 7% or 8% yield on his investment based upon the terms set forth by the private placement agreement. Are you with me so far?
Yes.
Or he can choose to hold on to that stock and age his position with the company. Hold on to that stock, because knowing that the financing and the money that's raised from private placement sale when the company needs the money the most is usually used as a bridge loan and a stepping stone for the underwriting of a new issue. This company is going to come back to Morgan Stanley Dean Witter and say, Morgan Stanley Dean Witter, look what we did with the $3.5 million of private financing that you raised us 6 months ago. Are you with me so far?
Yeah.
Now we're much more profitable than we were 6 months ago. Now would you consider bringing us public and performing the underwriting of a new issue for $20 million in the form of an IPO? And that's when the stock will be placed at a much higher valuation because the company is more profitable. And there you would have an opportunity for investment alternative number 2 in choice. Buy that stock. You bought that stock for $1.75 a share, if you will. Now the company's going to go public at $6.50 a share. A year later or 8 months later, are you with me so far?
Yes.
We'd have an opportunity to make money on the investment banking side by selling that stock to the open market that you bought for $1.75 a share at a $6 or a $7 valuation. If you believe in the company might work out. Are you with me so far?
Yes. Yes.
To make money on the investment banking side. Or simply sell your stock right back to the issuer after the 6-month period of time and earn your 6% or 7% yield on your investment. And so we look at the private placement sale. The staggering fees of underwriting are anywhere near what a company might more be able to afford associated with private financing with a private sale. This is called a Regulation D private placement sale. The document is called a Regulation D private placement offering memorandum, which is the document that's prepared by the issuer that uses and serves the same purpose of what the prospectus served, associated with the equity IPO process for stocks that went public. Are you with me so far?
Yes.
In that private placement memorandum is an investment letter when the client signs the subscription agreement agreeing to hold that stock for a 6-month period of time. Are you with me so far?
Yes.
And after that, either sell that stock back to the issuer or hold on to it until it goes public, the company, and blow that stock out to the open market to make money on the investment banking side. Are you with me so far?
Yes.
Merrill Lynch cannot sell that stock through a private placement sale to more than 35 non-accredited investors. The definition of an accredited investor is the individual that you seek when you're on the phone all day long, the individual with the financial liquidity and net worth and suitability requirements that we look for when we look to trade that top 2% of the net worth of high-end people in the industry. Are you with me so far in the country? And that is any individual accredited, are you with me so far, Series 7 Bullet 1, that has $1 million in net worth, or, watch what I say and watch how I say it, not and, or $200,000 in annual income for the last 2 years, with anticipation that that income level will be maintained into the future. That he has the net worth and the liquidity and the future liquidity to be able to continue to trade with you. Are you with me so far? Yes. That's the individual that you're seeking all day long, not somebody who has $50,000 invested in common stock or earns $65,000 a year, who at 48 years old is struggling and lost his 401k and possibly 1/3 of his income. Are you with me so far? Yes. You're looking for the one that is accredited. Are you with me? Yes. That's the purpose of cold calling and qualifying the investment profile. Well, if Merrill Lynch is raising money for a company through a private placement sale, are you with me? Yes. You can sell to an unlimited number of accredited investors. But you may not sell to more than 35 non-accredited, unsophisticated investors who do not have that kind of financial net worth and liquidity. Are you with me so far? Yes. There's a cap on non-accreditation. Are you with me so far? Yes. And if Merrill Lynch follows these requirements, or Morgan Stanley Dean Witter, then this is one of 3 alternative methods of financing that the company would be eligible to be participating with as one way that might be more cost-effective to raise capital for them when the costs associated with the underwriting process might be too expensive. Are you with me so far? I want to talk to you about a company called Seattle Coffee. You know this company? I don't know if you know it, but you know, Starbucks has been having a real hard time lately, losing a tremendous amount of market share and revenue because the world, I don't know if you know this, ladies and gentlemen, excuse me, I don't want you to read, I want you to listen to me, runs on Dunkin'. Are you with me so far? Because Dunkin' became more mainstream because they understood people's financial illiquidity, and for 99 cents and maybe a donut, you can have a great cup of coffee. You go buy Starbucks across the street for a regular cup of coffee, how much does it cost? It's $2.78. Are you with me so far? Now let me tell you, are you with me? Yes. Are you exhausted? Because I'm double your age. Are you with me? Yes. I'm going after NASDAQ, so stay with me and stay real sharp because you need to. Now, I want you to know that when you drink Starbucks, if you ever have, there are many people who are not Starbucks fans that say it tastes almost burnt. Are you with me so far? Yes. It's not burnt. It's just that strong. It's like Italian. See, I'm Italian from a borough, so I know about these things. When Italians cook with too much garlic, are you with me so far? Yes. It will taste bitter because of the bite on the garlic. Are you with me so far? Yes. It's not burnt coffee, it's just extra strong. Are you with me? Yes. And it's a small fortune. Anyway, for 99 cents, go get yourself a great cup of coffee on Dunkin' Donuts. And Dunkin' Donuts is just knocking the socks off of Starbucks. Starbucks is consolidating down. They're looking to do different kinds of programs and menus just to compete. At the time when Starbucks was expanding in the country, there was another company, high-end coffee, are you with me so far, and very expensive, that was a competitor to Starbucks based out of Seattle, Washington, called Seattle Coffee, which I happen to like a little bit better. Are you with me so far? Yes. Not that I dislike Starbucks, not that I'm in love with Dunkin' Donuts, but I just like the coffee a little bit better, and it's easily accessible to me. And eventually what happened in the story that I'm about to tell you was ultimately Starbucks ended up buying Seattle Coffee. Now they're owned by Starbucks. It's one and the same company. But that was something that could be seen a mile away. But I want to tell you what happened. The certified financial officer for Starbucks, for Seattle Coffee out in Seattle, Washington, got out of his office one day, got in his car and drove down the road about a mile and went into Morgan Stanley Dean Witter and said, Morgan Stanley Dean Witter, you know me. I'm your neighbor right up the road, Seattle Coffee, and I'm the certified financial officer of that company. And you know what we're looking to do? We're looking to overtake Starbucks and Dunkin' Donuts, and we want you to consider raising us $20 million. The use of proceeds are going to be used to franchise a Seattle Coffee in every major city in the country. Are you with me so far? Yes. Now listen, Morgan Stanley Dean Witter, there's a couple of things about Seattle, our company, our Seattle Coffee Company, that I want you to know. 80% of the money that you raise us, 80% of this $20 million, are you with me so far? Yes. Is going to be benefited and being utilized primarily by our operation in Seattle, Washington. That means only 20% of the use of proceeds is going to be benefited by our branches and franchises. Are you with me so far? Yes. Something else I want you to know, Morgan Stanley Dean Witter, 80% of our revenue that our company generates comes out of Seattle. 80% of our assets come out of Seattle. And 100% of all the people who buy this stock will only be residents of the city of Seattle, Washington. Are you with me so far? why is this method of financing called an intrastate method of financing? Because primarily the capital is raised for the company to be predominantly utilized by the operation within one state. Are you with me so far?
Yes.
Another name for the intrastate offering, it's called SEC Rule 147 method of financing. Are you with me so far?
Yes.
A company can be eligible for this type of financing if the company meets the following requirements. 7, 80, 80, 80, 100. Look at me. 80, 80, 80, 100. Series 7, 80, 80, 80, 100. Let's take a look at exactly what I mean. In summation one more time. In the body of your work, a few pages down there where it says at the top, exempt offerings. It's 9, I'm sorry?
917.
From now on, you are my guy. 917. Thank you, sir. Let's take a look at exactly, are we all there? I just need a yes.
Yes.
Thank you very much. I really needed that. Look at this. If 80% of the company's gross revenues, 80% of their sales are being generated from operations within one state. If 80% of the company's assets are located within one state, Seattle. If 80% of the proceeds of the $20 million financing are to be utilized by operations within one state, Seattle. And if 100% of all buyers who buy into the stock offering only live as residents of one state. Are you with me so far? I think you can see why it's called an intrastate method of financing, primarily financing within one state. And this is the second method of financing eligible to issuers if they meet 80, 80, 80, 100. Are you with me so far? Look at me. If a company does not need to raise more than $5 million or less during a one-year period of time, that limit, that dollar limit, and that timing, they are eligible for a Regulation A type offering of securities. Reg A, for a company who does not need more than $5 million or less during a one-year period of time. With me so far?
Yes.
Intrastate method of financing, Reg D, private placement financing, or they're going public, are the only methods of financing that are significant for NASDAQ for the 7. Are you with me so far?
Yes.
Let's go back to the beginning of the body of this work, this chapter. I'm on to the first page and the top of the next, where it says types of underwritings. Very beginning. Types of underwritings. Are you there?
Yes.
Are you there?
Yes.
You know, a company comes down to Wall Street and says, listen, Morgan Stanley Deanwood, really want you to consider bringing us public. Back to the public offering process now, like I promised you I would be. $20 million capital raise is what we're looking for. What happens if after 2 months of investment banking due diligence, the company is now meeting with Morgan Stanley Deanwood back in the conference room and wants you to watch me. Watch what I'm about to do. And Morgan Stanley Deanwood, look at me, watch me, look at me for a minute, goes over to the company and says, right at this meeting, right at this table, Mr. Johnson, certified financial officer of your company, you have our word on behalf of Morgan Stanley Deanwood and our firm commitment here on behalf of Morgan Stanley Deanwood, we're going to raise you to $20 million. This type of underwriting, I'm talking about types of IPOs. Are you with me so far?
Yes.
It's called a firm commitment underwriting. In a firm commitment underwriting, the underwriter, Morgan Stanley Deanwood, is giving their firm word and firm commitment that regardless of the performance, the lack of success, or the success of this underwriting, however it performs on the effective date, that company, the issuer, is guaranteed the full $20 million of proceeds with Wall Street's firm commitment behind the IPO. So that means if on the date that it goes effective, are you with me so far?
Yes.
5 Dow stocks come out with negative earnings. We have corporate malfeasance in the private sector and problems in the administration and a lack of public confidence in the economy coming out of the tailspin of the recession we're in. And that's the date that this company goes public and investors start running for the hills. And only $18 million worth of stock are sold of a $20 million underwriting. Morgan Stanley Deanwood would eat those $2 million of unsold stock because that company is guaranteed the full proceeds of the IPO, regardless of the lack of success or the success of the performance of the IPO on the effective date. Are you with me so far?
Yes.
For the last 30 years, ladies and gentlemen, this is the most prestigious type of underwriting because it gives credence to just how confident Wall Street feels this underwriting will perform and how excited Wall Street is about bringing this company public. Are you going to be so far?
Yes.
But what if Wall Street, Merrill Lynch, and Morgan Stanley Deanwood feel a little bit uncertain about these uncertain times? They want to raise $20 million for this company, but we know we're dealing with a lot of political, economic, and military instability in the world, let alone the domestic economy. Are you so far?
Yes.
And what if Morgan Stanley Deanwood looks at the company and says the following, listen, company, on behalf of Morgan Stanley Deanwood, we're going to raise you to $20 million. We can't guarantee the full proceeds, regardless of its performance on that date. We're going to give it our best effort, our best shot at this. But any amount of stock that's unsold on the effective date gets returned back to you, company, without any penalty to Morgan Stanley Deanwood. This is called a best efforts type of IPO. I think you're starting to see what's really happening. The different types of underwritings are based upon the way the money is raised. Are you with me so far?
Yes.
There's a Series 7 all or none type of IPO. Look at me. All or none. I'm going to come over to you and help you in this restaurant. You get 5-star service. I want you to listen to me. Raise all of the $20 million the company might be telling Morgan Stanley Dean Witter, or raise none of it at all. And then there's one type of underwriting that I want you to be aware of, especially for Monday on 9/21, when we get involved with limited partnerships and I start turning up the educational afterburners into levels you're not even going to believe you're capable of. And that is called a minimum maximum underwriting. Listen carefully. In a minimum maximum IPO, we call it mini-maxi in our industry. Listen carefully. A certain minimum dollar amount of money is required to be raised by Morgan Stanley Dean Witter for the company within a 6-month period of time. An amount at minimum that the company feels that they need just to get started. So let's assume, to use the example of a $20 million underwriting, are you with me so far? I talk about a $20 million IPO. Morgan Stanley Dean Witter says to the company, we're bringing you public. We're raising you the $20 million. Now look, company, how much at minimum do you feel you need right away within a 6-month period of time to get started hiring the labor and get yourself moving along with respect to cash flow? Company says, look, I need at least $4 million. Must be raised within a 6-month period of time of a $20 million underwriting. So the minimum dollar amount of money the company feels that they require is $4 million, which is the minimum needed by the company to be raised by Morgan Stanley Dean Witter within a 6-month period of time. In lieu of the residual, which is how much? $16 million to be raised 1 year out, representing that $20 million maximum IPO. Are you with me so far? Yes. If Morgan Stanley Dean Witter could not raise this minimum $4 million within that 6-month period of time the company requires, cancel the IPO. This is called the minimum maximum IPO underwriting. Now, we need to understand a little bit about the definition of a minimum maximum IPO, because most, if not all, limited partnerships are brought public in the form of a direct participation program, minimum maximum IPO basis. So when we start raising capital for oil and gas and real estate programs on Monday, most limited partnerships are brought public on a minimum maximum basis, where a certain minimum dollar amount of money is required by a general partner to get started with the beginning of the management of the program, whether it's to be utilized for real estate or oil and gas drilling. Are you with me so far? In lieu of the residual maximum 1 year out. So we deal with the different types of IPOs. 7, firm commitment, best efforts, all or none, and mini-maxi. Be aware of these different types of underwritings, because they're all going to play a significant role as we go through this entire curriculum. We start bringing different securities public along with different regulations. Are you with me so far? Yes. So we talk a little bit about the issuer. This is the company that wants to go public. Are you with me so far? Yes. And we talk about the broker-dealer, Morgan Stanley Dean Witter, and they are known as, in our industry, in the language of the underwriting of a new issue, look at me, the underwriter. To underwrite is to bring public. Are you with me so far? Yes. Now, if there's more than one brokerage firm, are you with me so far? Yes. Participating in raising capital for the same issue or in the same IPO, this is called a syndicate formation. Are you with me so far? Yes. In a syndicate formation, we have one firm. And I'm going to show it to you right now. I want you to look at me. Let's take a look carefully at the gurunet.com red herring. Look at me. Look here. I want to show you this preliminary prospectus, which is the same way the final prospectus will look. The issuer is gurunet.com. The number of shares that are being issued here, issued stock, is 2.2 million shares at a price of $5 a share for the raising of $11 million. Are you with me so far? Yes. I want you to look very carefully at what I'm about to show you. The firm on the left is called Maxim Group. That's brokerage firm number 1. The firm on the left of the cover of either the preliminary or the final prospectus is the most prestigious than any other firm, if there's more than one firm in this underwriting. Are you with me so far? Yes. Here's why. The firm on the left holds the prestigious title of what is called the investment banker to this issuer. What does that mean? It means that when gurunet.com wanted $11 million, are you with me so far? Yes. They first and only went to this firm, Maxim Group. Are you with me so far? And they said, Maxim, look, we'll give you investment banking deposits. Put your corporate finance investment bankers on our company. Take a look at our financial statements, spreadsheet us, and I think you'll see we justify for an $11 million underwriting. Would you consider Maxim Group bringing us public? Maxim Group decided to perform the underwriting, obviously, as you can see. Are you with me so far? And then I want to tell you what Maxim Group did. They picked up the phone and called up another brokerage firm B, Early Bird Capital, the firm on the right. And they said, look, Early Bird Capital, Maxim Group here, we got a company that's been with us for a couple of months. We took them through the investment banking due diligence. We really like what we see. This could be a significant performance regarding its equity IPO. Do you want to participate and come into our deal with us and split this underwriting with us? Are you with me so far? Yes. So what did Maxim Group form? They formed a syndicate formation. A syndicate formation is when there's more than one firm participating in raising capital for the same issuer. Now what's important for your education is this. Do you see the formation of this syndicate formation? One firm on the left. And why is Maxim Group so important? Just because they have the title of investment banker that the firm on the right does not? Well, no. It also means that the firm on the left, Maxim Group, is going to be receiving investment banking fees that no other firm in the syndicate will receive. They run the investment banking book to this underwriting. Are you with me so far? Yes. They're the point brokerage firm on this deal. Are you with me so far? Lead quarterback, if you will. Are you with me? Yes. Right. To use that NFL analogy, now that we're in the NFL season. Now, if you look at the split, these two firms are both on the same line. Are you with me so far? They are not higher or lower than one another. Are you looking at this? That means firm on the left and firm on the right, same line. This is called a co-syndicate formation. In a co-syndicate formation, two managers here, they are both splitting the raise and responsible. In $11 million underwriting, each firm is responsible here of the two to raise $5.5 million of an $11 million underwriting. Let me so far. Yes. What if I showed you this formation? Take a look at this formation. This is syndicate education to a higher level, and you're going to need it now when we get into the municipal bond syndicate underwriting for municipal offerings. I show you the front page of a red herring or a final prospectus. I show you the name of the issuer is at the top, the company. Are you with me so far? Yes. Are you with me? Yes. Wake up. Now look, I show you a diagonal try. Are you with me? Yes. Firm on the left. At the top of the diagonal is the investment banker to the issuer, runs the investment banking book, and there are two other firms, all three on a slant. Are you with me so far? Yes. Each firm is responsible for the allocation and the raising of 33 1/3% of the underwriting. Are you with me so far? Yes. So what do you know about the syndicate formation now? Based upon whether it's quad, tri, co, are you with me so far? Determines the percentage of allocation of shares that have to be sold and the raise of the underwriting of the new issue in a syndicate formation. What if you look at a preliminary or final prospectus? Like, look at me, Healthy Fast Foods. Are you with me? Yes. $14 million raise approximately. There's only one firm here. The way that it looks on the red herring is the way it's going to look on the final prospectus. This is not a syndicate formation. There's only one underwriter here raising that money for that issuer. Not only are they the investment banker, but they are an exclusive firm here. There's no syndicate formation, and so this will be known as a singly managed underwriting by one single managed underwriter. Are you with me so far? Yes. So whether we talk about a syndicate formation or singly managed IPO, we're going to get into more details when we start getting involved in week 3, if we make it that far, and I really hope that we do, in syndicate formation and syndicate structure, especially for those municipal bonds, which are waiting for you when you get to that point. Well, we talk a little bit about the underwriting of a new issue, alternative methods of financing, and now I want to draw your attention to this language regarding Rule 144. Please listen to me. I got a fine point in many areas for you that you need to be aware of. SEC Rule 144, SEC has nothing to do with Rule 147. Let me just say that right now. Look here. SEC Rule 147 is also known as the intrastate offering. Are you with me? Yes. SEC Rule 144 is an SEC rule, listen carefully, that regulates the sale of restricted stock and control stock. Are you with me so far? Yes. Okay. Now, in order to understand the rule, I think we first have to understand the definition of restricted stock and control stock. Because that SEC rule is regulating the trading and the sale of restricted and controlled stock. Are you with me so far? Yes. Let's first talk about another name for restricted stock. What is another name for restricted stock? Known as private placement stock. So when the SEC came in under Rule 144, what did they say regarding the timing mechanism of the sale of restricted stock? Answer. Wake up, 6 months. It's right here for you. With me so far? Yes. So with respect to that one aspect of Rule 144, regulating the sale of restricted stock, the SEC has said, buy private placement stock, subscribe and buy into the private placement offering memorandum, got to hold that stock for up to a 6-month period of time, and then it's freely traded. Sell it back to the issuer or hold on to it and age your position when the company goes public, if you believe in the company. Am I right? Yes. So the sale of restricted stock is a when issue. Are you with me so far? Yes. But the other aspect of Rule 144 is called the sale of control stock. In order to understand the sale of control stock, you have to understand the definition of control stock. Are you with me so far?
Yes.
Okay, so look at me. I'm going to ask you a question. Do the best that you can. There's no right or wrong answers here from you. I just want you to respond. Give me the 2 words on Wall Street. Listen to me carefully. In the form of 2 financial terms where the most money is made in this entire industry. 2 words. You can speculate. What do you think? 2 words where the most money is made. No, that's a security.
Underwriting.
Underwriting is 1 word, Spinelli, and it's just like you. It's 2 words. No. Any idea where the most money is made in this industry? I know you don't know it, but I was just asking, speculation is 1 word. Are you with me so far? Thank God you're not playing Jeopardy. Are you with me? Because you would not do so good. Can you say these 2 words to me right now? Say them again. Stock options. That's right. Not derivatives, not option contracts. Listen to me. Stock options. Now, who's Ron Perlman? I ask you, do you know who Ron Perlman is? I'm shocked. And I ask you specifically because you're a woman. I thought you might know that. Ron Perlman is the chairman of Revlon, the makeup company. I thought you might know that. Even if you don't use Revlon, I thought you might know that. Even if you're a Lancome or whatever you might use. You know how much money he earned last year? $1.2 billion. The $1.2 billion is not salary. His salary is only $700,000, yet he made in excess of $1 billion. Look at the CEOs and the COOs of all these Fortune 50 and 500 companies, and I'm going to make sure everything looks really good for you later as long as you listen to me now, and I promise I'll help you. So you got everything all tidy because I don't want you to miss me. Look at these guys and gals. They're making a lot of money, in excess of $800,000, in excess of $1 billion. Well, all that money is not salary. Are you with me so far?
Yes.
So where's the rest of it being made in their overall package, right? And what's that package consist of? Well, I got to tell you right now that Ron Perlman, as just one example of many CEOs, owns stock in Revlon, which is a publicly traded company. And the stock he owns, significant position, are you with me so far, is at a price that's at a considerable discount to the market price of that stock where it's trading at in the marketplace. Look at these people I'm qualifying for you. These people are known as control persons. Why are they called control persons? Because they are CEOs and CFOs and chief executives and presidents in some type of control over the management and direction of these publicly traded companies. Therefore, the stock that they own is called control stock. Stock that's owned by a control person. Are you with me so far?
Yes.
Are you with me?
Yes.
Now look, I want your first day to be really important for you so that it could be used as a springboard to come in here strong for each one of these days because you have no choice. So I'm going to ask you a question. Do you really believe that the SEC is going to allow a control person who owns stock at a considerable discount to the market price of that stock of companies that are publicly traded, the ability to be able to sell that stock to the open market anytime they want to capitalize on short-term capital gain swing profits? Yes or no?
No.
The answer is yes. There isn't much about this industry that you know. And the next time you pray, whether it's to Allah, to Jesus, to Yahweh, or whatever your belief is, you should say, thanks for Mr. T, because thank God I got this guy, because you know nothing. The answer is yes. And so you think that's unfair, right? That Perlman, for example, who owns stock in Revlon at a cheap price from where it's trading at in the market, would have the audacity and the ability legally to be able to blow that stock out to the open market any goddamn time he wants and make unfair capital gain swing profits to the investor public? Well, but SEC is going to step in and regulate the sale of control stock. Well, it's not when. It was when for restricted stock. Well, if Rule 144 is also regulating the sale of control stock, and it's not when, then one aspect regarding control stock sales are being regulated associated with Rule 144. How many shares? Oh, it's a volume rule. There's a Jesus Christ. If you're Jewish, Yahweh, Kwanzaa, whatever you believe in, and he's good. It's how many shares, right? Now the rule says, and you're going to love this one because the rule sounds very powerful, and it is. It's just not on NASDAQ, and the only person that knows something like that is me because nobody knows the 7 the way I do on the planet. But the rule says that the maximum number of shares that a control person could sell to the open market regulated by the sale of control stock under Rule 144 is 1% of the float, which means 1% of the outstanding shares, versus, or the average weekly trading volume for the last 4 weeks. The greater of the two is the maximum number of shares that a control person can sell to the open market anytime they choose. It's a volume restriction rule. So why don't we do our first mathematical transaction together? This should give me an indication of what's going to happen when we get to margin and options. Are you with me so far? Which I'm already concerned about. I got a company with 7 million shares in the float. Are you with me so far? The average weekly trading volume for this company for the last 4 weeks was 60,000 shares. So 1% of 7 million is 70,000. Thank you very much. You're scaring me already. You're not answering me. The average weekly trading volume for the last 4 weeks of this company was 60,000 shares. What's greater? 70,000. So here, a control person can sell a maximum of 70,000 shares to the open market anytime they choose. Are you with me so far? It's a volume rule, and that's concerning the sale of 144 control stock. It's a when issue restricted. Are you with me so far? So the volume rule, which sounds very important, is not on NASDAQ. Are you with me so far? Everybody that doesn't trade with me studies that rule. But the question now becomes, what is on the 7? The 7. I have to bow in humility. There's no question about it. And the regulation is a little bit different. It's not about the volume rule, but it's about the execution that a financial advisor gets for an order for 144. Are you with me so far? Listen to me. Are you with me? The 7 is another world. I'm in the middle of a war up here for you, and you don't even see it yet. Wake up. The following is the question for the 7. And if I were you, I would listen. The question, everything on NASDAQ is a transaction. A financial advisor receives instructions from a control person regarding the execution of an order for 144 control stock. I speak just like this test. Are you with me?
Yes.
The following is the procedure to be followed for execution. They don't want the volume rule. What do they want? They want the regulations on how you ought to fill that order, because it's a three-pronged step approach that you have to follow in order to sell 144 control stock. And that area lies under the area in the body of your work of 144. And our colleague from Mississippi is going to tell us, I'm sorry?
Thank you.
Your first name, sir?
Mike.
Mike is our TI-222 guy. He's going to give us that page. 19, Mike? 1918, 918, 918, not 1918, we're all delirious here. 918. And so, we deal right there in the second and third paragraphs of what the regulation requires, and it's not as complex as you think, but you would never know the 7 is looking for something like this, and that's the whole point of what you just can't determine from any other program, and that's why I'm happy you're here. When Series 7 account executive has an instruction, that would be you on the NASDAQ. Perspective, like I promised you at the beginning of today. For the execution of an order for 144 control stock, step 1, Series 7, you have to notify the SEC that you have an order for 144 control stock sale. So the first requirement is notification to the SEC. It's right there, second paragraph. Step 2, Series 7. The financial advisor has 90 days to fill the order. Step 1, inform the SEC that you have an order to fill for the sale of 144 control stock. Step 2, you got 90 days to fill the order according to that volume rule. Are you with me so far? Yes. And step 3, look at me. If you have not sold that stock within that 90-day period of time, you must amend your notice of sale to the SEC. So the regulations is about execution, not the volume rule. Are you with me?
Yes.
Thank you. Are you with me?
Yes.
Thank you. And therefore, the regulations associated with 144 control stock and 144 restricted stock sales under the regulations set forth by the SEC. Question?
What was the third one?
Third one, amend your notice of sale to the SEC. If you haven't sold stock under Rule 144 within that 90-day period of time, then you have to amend your notice of sale to the SEC. It's all about notification. No one ever suggested you would violate the volume rule. You with me so far?
Yes.
Right. You know, I want to talk to you about shelf registration. Next page, body of your work. Colleague? Page 919, shelf registration. Look at me. I'm going to change this meeting right now. This is going to be an exciting, really, thought if you think about it. This is no longer a Series 7 management training program. I want to tell you what this is. This is the first of many board of directors meetings that we're going to have, because you and I, we just became partners and we formed our own company in New York City. Wouldn't that be really exciting? Right in the middle of the financial capital. How entrepreneurial does that sound? Anyway, we're at our first board of directors meetings, and your first, Mike?
Yes.
Mike is going to be taking the minutes because he seems like he's pretty excited about that. We're all partners here, and we're having our first meeting of hopefully many about how we're going to build this company into an American powerhouse. Are you with me so far?
Yes.
First part of this meeting is about our short-term goals and how we're going to be able to survive the first year. Are you with me so far?
Yes.
It's competition to increase revenue with respect to marketing and sales and demographics to get to the point of getting to a point of getting a certain level of market share. And the second part of our meeting today in this board of directors meeting is about how we're going to survive after the short term. Our long-term goals to become 15, 20 years from today as big as U.S. Steel and Monsanto Chemical, and where we want to be globally over the next 15 to 20 years. Short-term goal part of our meeting, long-term goal part of our meeting. Well, I have our short-term goal meeting. And by the way, I'm pretty excited about it, partners. You came up with some really exciting and ingenious levels of marketing strategies to be able to increase and get the brand name out there, to increase profitability through production and sales within the first 6 months. And now we're into the second segment. And that's when Jose Rosa, one of our partners over here, said, well, listen, we want to be as big as U.S. Steel and Monsanto Chemical, and we all have that entrepreneurial dream 10, 12, 15 years from today. But if that's the case, and we're going to be like as big as those some of the conglomerates, which is why we formed this company, well, then we're going to have to offer our employees 5, 7, 10 years out when we become very profitable, real employer-employee plans. And that's just when, your name, sir? That's when Joe said, yeah, like Walmart, you know, they give their customers profit sharing, their employees profit sharing, stock option plans. And that's when I said, you know, I got an idea on how we can achieve some of those real employer-employee plans. Why don't we take some stock in our company's authorized shares, or from our company's authorized shares? And literally, we'll take 2 million shares of some of the stock. Are you with me so far? And we'll, you know what we'll do? We'll put it on a shelf. We'll tuck it away. Oh, we'll tell the SEC we're doing this. In 5, 7, 10 years from today, when we become more profitable, we'll be able to issue that stock and allocate it to our employees to allow them to participate later on a continuous basis into stock option plans, to give them stock options in our company, and then hopefully down the road 401k plans, qualified retirement plans, and profit sharing plans. Are you with me so far?
Yes.
The filing of and the shelving of that stock on the shelf requires the company to file with the SEC a shelf registration. Are you with me so far? Yes. That we are, as a company, telling the SEC we're taking a certain number of shares and literally shelving it away, specifically to be used and allocated to our employees and given to them later on a continuous basis to allow them to participate in stock option plans. Are you with me so far?
Yes.
The question becomes not the filing of the shelf registration, how long, this is 7 now, how long is that stock required to stay on that shelf, that if we haven't used it, we might have to file another new shelf registration? And Series 7, the answer is 2 years. The answer is 2 years. If we as a company have not allocated those shares of stock that we've literally shelved to allow our employees to participate in stock option plans for a 2-year period of time, then we would have to file a new shelf registration with the SEC and refresh and renew it. Are you with me so far? And now I'm into the next page that you see right there in Rule 145. Are we all there? Stay with me. I'm mowing the 7 down. Are you with me?
Yes.
Now, I get these letters that are sent to me, and I hope that you get them sent to you once in a while too. And if you don't, I'm pretty much going to get an idea that you're going to look forward to it. But when I get these letters sent to me, my heart literally palpitates. Look at me. The investor starts out like this. Look at me. Dear investor. And I get all mushy all over when I see stuff like that. Well, I want to talk to you about a company called America Online. You know the company? AOL. Oh, they're not called AOL. What are they called? Say it again? Time Warner AOL. No, AOL Time Warner. You got the name wrong. It's the other way. Are you with me so far? Why is it called AOL Time Warner and not Time Warner AOL? Because something happened not too long ago. AOL came along and bought Time Warner. I don't understand if you really understand what I mean. Are you with me so far?
Yes.
Because that's just shocking news. I'm going to tell you why. The real company over here is Time Warner. My colleague is the specialist in Time Warner right on the floor of that New York Stock Exchange. They've been around for many, many years. They have real sales, real earnings, 2 million subscribers, a dividend on the stock. They're a real company. And what happens? The overvalued tech stock comes along and buys the blue chip company. That doesn't happen in life. That's not supposed to happen that way. What was supposed to happen was Time Warner's supposed to buy AOL. AOL's not supposed to buy Time Warner. Are you with me so far? Yes. It's like IBM being bought out by a tech stock. Are you with me so far?
Yes.
But life is unbelievable, isn't it? AOL should have been out of business on 4 different occasions financially. We all knew it on Wall Street. And then they got to a point where they're sitting on billions in cash, and they came along and they bought Time Warner. Shocking. That the overvalued tech stock comes along and buys the seasoned large cap blue chip issue. Amazing. So anyway, for all of us who owned Time Warner stock, are you with me so far?
Yes.
The minute that acquisition was facilitated and approved by the SEC, the new name of the company is AOL Time Warner, because AOL is the acquirer. Time Warner was acquired. Are you with me so far?
Yes.
So we got a new name change on the stock, am I right?
Yes.
And as a result, the SEC sent a letter to every investor who owned Time Warner stock, and the letter went just like this. Dear Time Warner shareholder, I get all excited when I see that. As a result of the recent acquisition for Time Warner by AOL, the new name change of the company and the reclassification of the stock's name is now called AOL Time Warner. Your Time Warner shares will now be exchanged for AOL Time Warner stock. Are you with me so far?
Yes.
And AOL had to file a Rule 145 with the SEC. A Rule 145 is required when the company has a reclassification of the stock name as a result of a merger or an acquisition. A Rule 145 doesn't have to be filed for a stock split or a change in the stock's par value or to clear the dividend distribution. It's only when there is a change of the reclassification of the stock name as a result of a merger and acquisition. Are you with me so far?
Yes.
File Rule 145 with the SEC. Are you with me so far?
Yes.
And so now we deal with a tremendous amount of language associated with the equity IPO process. Are you with me so far?
Yes.
And I want you to make this assumption that this stock is now publicly traded. Are you with me so far? In the regulations that we have just established under the Securities Act of 1933, I'm going to give you a 7-minute break, because it's not quite 5 minutes, it's not quite 10. This is your last break for the day, because when you come back, I'm going to then move into Chapter 11 and start now buying and selling and trading this stock, which is now public. Are you with me so far? In the regulations that we've just established out there on either NASDAQ or a major exchange, wherever it's listed in the secondary market. Chapter 11, secondary market trading. I'll see you in 7 minutes. Thank you. Thanks, Brian. Gotta love the